Here's a question from the audience. What they're asking is that the valuation of startups vis-a-vis their financial results and cash burn is very different today than at least when you and I were out selling IPOs in the your firm and our firm were out selling IPOs in the early 90s. And even now, there is a lot of pressure for bankers to kind of go out and quote the highest price, and pressure from the private equity, which is looking at exits, to ask for the highest price. So how do you think the promoters, how should they think about the valuation, and how should they balance what is in the interest of the private equity player at that stage, maybe in the interest of their employees who want a high exit, versus those of the retail investors and other investors who would come in at the time of the IPO?
I'll just give two examples. One is the example of Facebook. Facebook probably got listed more than 10 years ago. I still remember very vividly. Its listing valuation was around $30 billion. And most analysts were saying, where is the revenue model? And Facebook post-listing actually went down. A little more than 10 years later, Facebook, from a $30 billion company listing at below the $30 billion valuation, is now a $1 trillion company. And it was able to, along the way, from being a social networking site for friends, being able to build a business model which created this revenue stream and the revenue engine. Therefore, I think there are many, many cases of a particular business model which is able to attract customers, and over time being able to monetize it effectively to a great revenue model. Therefore, you want to look at each of these startups and ask the tough question: what are the unit economics? What are the potential revenues? How will we get there? And do we have enough ability to sustain it through this period? And markets over time, public markets, will get smart in terms of recognizing the right levels of what works and what doesn't work. It is still a very early stage in the Indian listed space of startups getting listed. Therefore, it is under the process of evolution. However, I would also like to bring another point into mind. Last 2 years, many investors assumed near zero interest rates, or maybe 1 or 1.5% long-term rates, was something which will remain forever. Therefore, the present value of cash flows 5 years later is, if it is the same as what it would be 5 years later, then your valuations become very different than when you start pricing the cost of money. I think the cost of money has begun to go up. And should that go up, I think we'll now see the risk pricing and the present value pricing come into valuations of startups. It will also be, as interest rates go up, the hurdle rates which investors will expect as returns from their investments will change. And at some point of time, if rates really rise significantly, then debt becomes a more serious option for institutional investors as well. Therefore, the startup world has to be bracing itself for a time when real interest rates will happen over the next few years. Even today, real interest rates are negative almost everywhere in the world. Therefore, the price of money is one of the most important aspects in pricing equities. It has been considered to be near zero for the last couple of years, but Cinderella times will not last forever. And I think we are not very far away from the clock striking midnight.